planner, or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Drew Meredith, welcome to this episode of the Australian Investors Podcast.
Good to be here as always.
It is. For those of you that aren't on the video version on YouTube, which you are going to miss some things today, I must say. You may have noticed that we have a new disclaimer, quick one, into the show, because Drew last week said I looked too young.
I think you had a tan in this one too, so
yeah. I think
you're quite tanned.
I think one of the things that
post-fishing.
Yeah, I wish. One of the things that I realize is that if you want the cure to getting old really quickly, to start a business. That's what I've figured out. It's taken me this long to figure out. But you know what else I was thinking of, Drew? Some people may have already noticed this by listening to the video. Can I just jog your memory of something that happened last week on the show? I'm just going to I'm just going to remind everyone what happened last week. You have to have a choice between going to maximum security prison for 1 year or going for as long as it takes you to solve a Rubik's Cube. Which would you pick?
Rubik's Cube, definitely. It's not that hard, is it?
How long would it take you to solve a Rubik's Cube?
I don't know, like an hour. I
Interesting.
think. I don't know. I think there's like 12 moves down there for a Rubik's Cube that you can work out pretty quickly if you practice.
I'm going to get you a Rubik's Cube, and if you can solve it in under an hour, I'll go to prison for a year. How about that?
My problem is concentrating on it for an hour.
Anyway, it keeps going on and on and on. But what would a man do? How far would a man go to not be in the ring, to not be the man in the ring and go in there and solve the Rubik's Cube? Well, I'll tell you what he'll do, folks. He'll start trying to cut a turnip or whatever the heck you were trying to cut this week and just about slice his finger off.
Well, I was trying to tell the story. I was using some sort of circular saw rather than a mandolin.
So Drew ended up in hospital this week, and we tried to record yesterday, I think it was, or the day before, and he was trying to cut something, like anytime a white man makes a salad, you know things are going to go wrong. But what actually happened?
Well, it was slicing fennel, not turnip. And anyone who's eaten fennel knows fennel needs to be incredibly thin, otherwise you get that really licorice flavour. But like any good man, I took the guard off the mandolin when I was doing it, and a short trip to the not a short trip, it was a short trip to the hospital, but it was a long time at the hospital. So ended up losing. I didn't lose it. The finger stayed attached, and had 4 stitches after about 12 hours in the waiting room.
Wow, mate.
And I'm not doing a Rubik's Cube anytime. I probably still could. Is that your pointer? Yeah, pointer finger.
Yeah. The old, you need a finger to solve a Rubik's Cube. It's like, I didn't realize you would go to this extreme to get out of the Rubik's Cube challenge.
To avoid it.
Yeah.
Well, this is what happens when you try and eat healthy, isn't it?
Ah! Oh! Ouch! Ouch! Ouch, Charlie! Ow! Charlie! That really hurt! No, Charlie bit me.
Oh God, this is why we're going to do it in person. Then you can't put all these extra cutscenes in there.
I was trying to find any and every finger-related joke I could find on the internet, and thanks to Monique for pulling together some material from the internet.
Oh, thanks, Monique. The only way's up anyway, so.
Yeah, just point me in the right direction of the dividend stocks. So anyway, what have you been working on this week?
Apparently humans are like lizards anyway, so it'll be about a week and we'll be back to normal, and I can still type.
Really?
Somehow. Still working on the retirement book, so that's progressing pretty strongly.
Retirement book? What's the retirement book going to cover? Tell
retirement.
Oh.
The emotional and financial, it is the golden years, navigating retirement, or that's basically helping support people make better decisions in retirement. So like everything we do at Wattle, it's going to cover the whole gamut from free kicks in retirement to dealing with the emotional stresses, finding purpose in retirement, how to invest differently in retirement, and kind of bring all of it together with some, probably similar to Morgan Housel, some simple rules. We've got our golden rules of investing for retirement, but there's also the golden rules of a successful retirement. So aim is to have the manuscript finished in the next week or so, and for print March, April next year.
Oh, wow. That's great.
Exciting.
Do you have a publisher
Definitely.
yet?
Yeah, Major Street. So I think the same group that Kate Campbell published with as well, Leslie
Yep.
Williams.
Yeah.
And it's
Oh, cool. So you'll be able to get that on bookshelves soon.
Yeah, I think the key is those practical examples as well. We've seen, as you see, thousands and thousands of families that are heading towards retirement, and all the various different issues and outcomes that can happen. So using our experience and providing case studies throughout that shows that we all probably think we're different, but we're all very similar in most ways.
So this would be a book, because lo and behold, I'm actually still just learning about this book, by the way, everyone. Like I'm just like you guys. So this book would be predominantly for people in retirement or people preparing for retirement. Like
the aim is a bit of both. So anyone, you could pick it up at 20 or 30 as long as the tone is right. And we think the tone is right, but gives you some strategies to do in your 30s, 40s, and 50s. A lot of it is focused on what to do in retirement, but like every part of we prepare for our careers by studying and doing all kinds of extracurricular activity. We don't prepare for retirement. So there's so many things you can do before that help that transition, where the industry, financial advice industry, the investment industry doesn't do it well at all. Most people finish their job, next day they get a statement from their super fund saying, here you go. And it's like, what do I do next? There's no transition, there's no support. That's why people turn to podcasts, to blogs, to everything else.
Yeah, fair. That's kind of cool. There are a couple of retirement books, but not that many, and not that many that are kind of really succinct and focused on people, particularly in retirement. Like, I know you've done a bit of work with John Glass, and we heard him speak the other week at the retirement event. But that's good. It's good, man. I'm actually excited. It's going to be great to have two authors in the studio. Well, is Jamie an author? Is it like a co-authored thing? Are you guys working together on this?
Yeah, we're co-authors. So Jamie and I both. You'll be the odd man out.
Yeah, I was going to say. So it'd be like you, Kate, James Dunn, Jamie. Has anyone else in the
Evan's written a book too, hasn't he?
Evans, written a book. Pete Warden's written. Everyone's written a bloody book.
Except you.
Except me. I can't write, so that would help.
Credit to
you. Yeah, I was actually wondering, do you ever watch John Wick?
I will, sir. I will be of service.
Very well, my son. Cast aside your weakness and reaffirm your fealty to the table. Mr. John Wick. Breton Chauve. Warrini.
And anyway, John Wick goes on to cut his finger off.
Yep, I thought so. I just knew it was kind of there. Of course it was. More context.
If you ever want to just like numb your mind, like forget psychedelics, I guess, and just watch John Wick. It's one of those shows where you can just sit there and just stare at the screen and everything just blurs into one big action scene. There's a time and a place for it, I guess. Anyway, what else other than trying to cut your finger off? What have you been working on?
A lot. There's a lot happening in markets at the moment. A lot happening in inflation and trying to, and retail sales, trying to set something for the next 12 months, get some idea of what's happening. But then back to writing. I'm not sure if you've seen that. So been pumping out quite a few articles for our publications that probably similar to yourself. You, as we do here, you have conversations with a lot of people during the week. And when you're listening, there's so many takeaways or applications when you're actively listening and interviewing people. So I pulled a few just random articles out of conversations with other financial advisors or yourself.
That's cool. So you just you pull them together and publish them. I know you do the daily and everything.
Yeah. I think one was this idea of the use of language, and something that I think I referred to, like yourself, Kate, Victoria, Divine, in terms of how a lot of the advice industry has struggled to connect, not just with younger clients, but with clients in general. And it's because the jargon that we use. So we met another advisor, Peter Leggett. I think you've met Peter before. And he talks about portfolios almost like football teams. And how do you break down some of the words that we use, duration, carry, even fund manager itself isn't necessarily the best word either. So how do you break down these language barriers and make them easier to understand for the masses? And I think people like yourself have done much better at that than a lot of the industry has, and that's key to building long-term relationships as well.
Oh, thank you for saying such fine words. Yeah, I think it is. I think the language that we use has deliberately been what a word. I love this word, obfuscated. It's a word that means things are unclear deliberately, and we use that word, and no one really understands what it means. But basically, what I mean is we use words that deliberately make things seem more confusing than they are, and we don't realize this because as financial professionals, we're indoctrinated into this world that accepts the language to make things simpler. But at the end of the day, a lot of the words that we use are just unnecessary, just totally unnecessary. So, and the
We've got
abbreviations, the acronyms, like, wow.
there's a tendency to overcomplicate simple matters and oversimplify complex matters. I think
Yeah.
if there's one thing that finance is known for, it's that.
Yeah, and we do, but it's interesting because there are like parallels between the simpler concepts and the more advanced concepts. It's just if you go to a financial planner and they give you the simple concepts, you feel like you know it and it can't be that easy. And if you go to a fund manager and they say, yeah, we know valuation doesn't really work, so we just try and be generally correct. If you go in there and someone doesn't have the confidence or the conviction in their abilities, there's no way you're going to hand over $200,000 for them to invest for you. And that's just the realities of the way the kind of institution of finance has come together. Do you have a link to that we can put in the show notes? Because that'd be really interesting for folks to have a read.
Yeah, definitely. It'll be up on the
Yeah.
Inside Advisor, I think, so
Yeah.
for the advice audience, but it makes sense.
Yeah, cool.
And one of the other ones was finding a niche that, like in everything you do, you find each of your podcasts has a niche, basically. And advice practices need to find a niche as well. Could be anything.
Yeah.
Could be green, could be retirement, could be income, could be age pensions, but finding a niche which allows you to concentrate more of your energy and add more value to your clients.
Yeah, become an expert, like an Australian expert in that one domain.
Yeah.
I think that's one of the things. That's one of the things we've been talking about recently is how hard it is to get financial advice in retirement, and where do you go to find them? And if you do go to a lot of those places, like a lot of them have certain minimums or certain structures, but like some of those things make sense. But like it would be nice just to know I am a retirement financial advisor. This is what I specialize in, which you guys do so well, but a lot of others don't. They're just it's a totally different thing. I was chatting to I'm trying his name evades me. He's Sam, and he's associate professor at Melbourne University. We were chatting to him last year about economics, and he was saying that like in your investing, you want to go as broad as you can, but in your profession, you want to go as niche as you can. So you want to become a specialist in your field and earn as much money as you can from being that one person that delivers that thing. But then for your investment portfolio, you want to be as broad as you can because you want to diversify and capture the benefits of diversification. It's quite an interesting way to think about it. So I said this yesterday, but I had a wonderful day yesterday. I should say that I started the morning at 6 a.m. recording with Shane Parrish, and that interview will be coming up soon for folks. Many folks will know him. I think he runs the best website on the internet.
Best internet.
He runs the best internet. He's actually a coder as well. But he runs the best website on the internet, which is fs.blog. It's the Farnham Street blog and community, the Knowledge Project podcast. He has written 2 books. The most recent is Clear Thinking, which is a wonderful book. So it was great to connect with him. And I think he may be planning to come to Australia soon. So that would be wonderful. Caught up with David Lamont from BHP yesterday. They've got a lovely office, I must say. And Mike Kemp, former Barefoot investment analyst and author of the Ulysses Contract. He was on Rask Live this week, so that will probably be turned into a podcast as well. So I know I gave you a present this week, Drew, that was like kind of reflecting on this, but like the importance of gratitude is so important. Like it's just really lovely to be able to say that that's how you spend your day. For me, anyway. It's not everyone's cup of tea, but I think it's important that we practice gratitude in our life, and that because it gives us a moment to stabilize where we're at and focus on the future in a positive way.
There's a quote that came out from, we just had an event up in Noosa, I think it was Brooke Hansen, who also said pressure is a privilege.
Yeah. Yeah, that's a good way to put it.
Yeah.
It is right. Because at the top, in the moment, you're thinking, I've got to do this, I've got to do that.
Yeah.
You know, all these different things that overwhelm you. But then you step back and you remove yourself, you're like, wow, actually, I get to do this. So that's pretty cool. Like we have some team members overseas, and they, you know, don't have the same access. So until you experience that, you don't really get that appreciation.
I
But
turned my to-do list into a get-to-do list. That was like my starting point.
oh, that's cool. I like that. A get to do list.
Yeah.
I like it.
It's not
Like,
always fun, but at least every time you see it, it says you get to do that, not you have to do it.
yeah, I like it. Yeah, this week it would be remiss of us not to mention that Charlie Munger passed away. As Scott,
Sorry, I should be laughing at that.
no, you just know you just got a quote that you wanted to share that he said because he was so witty.
For context, yeah.
I think Scott Phillips from Wattle said it really well when he said, like, we lost one half of the world's best investment partnership this week, which, you know, Charlie Munger being the investing partner of Warren Buffett, about a month away from his 100th birthday. Absolutely wonderful investor. And I think all of us are thinking more clearly about two areas of finance and the world more clearly thanks to Charlie Munger. One is the idea of buying compounders. I think that's one thing that Charlie really brought to both Warren and to the investment community at large. But the second thing is actually, I think one I take away from it is his impact on behavioral finance. And I know we talk about like Daniel Kahneman and all these types of people for their prizes and stuff that they win about behavioral finance, but Munger definitely brought those mental models and the lattice work of mental models to the fore for business people, and it's just completely revolutionized the way people think about business.
So few people outside financial services knew of Charlie Munger too, which was weird. Pretty much everyone he knows of Warren Buffett.
Yeah,
but he was always, maybe not always, but for the longest time was it's like his equal. It's not this.
Yeah.
I don't think it's second in command. He was basically his equal.
Yeah, I put it this way: if I had the chance to have dinner with someone, it would be Charlie Munger before Buffett, and I think Munger's skill sets would be much more will be in the next 20, 30, 40, 50 years much more valuable to investors and all of us listening to this than Warren Buffett's skill set of, you know, trying to find companies and these types of things. I think the behavioral elements and the focus on psychology that Munger brought to the world is the one last competitive edge that someone could possibly have in the world of investing, at least in direct companies. And so
for the retirement book, he didn't retire until he was 99.
Didn't retire till he was 99. There you go.
That's
We're still going. Still going. I asked you just quickly to grab one of your favorite quotes, Drew, and you did have a look at one and it made you laugh. So give us one of your favorite Charlie Munger quotes, mate.
It's very much about continuous learning, which he clearly did, and he kept working. And it was the idea that without this learning, this probably isn't the most appropriate quote. You're a one-legged man in an ass-kicking contest. You might have to blank that out.
That's fine. So the quote is, without continuous learning, you're a one-legged man in an ass-kicking contest.
Exactly. It's just not going to work very well.
Yeah.
And but that was so much his commitment to constantly learning and challenging. That's probably why you're saying he would be a better dinner date than Buffett, because it seemed like Buffett was more stuck in the historical ways where he was able to adjust to the changing environment. Like he had comments on crypto. He was very deeply considering all the new alternatives that were coming out, and it's that willingness. We see it too often where, you know, the Buffett quote is always, if it's too complicated, don't invest in it if you don't understand it. And I'm always on the other side of educate yourself so you do understand it, or otherwise you miss out this massive broad universe of opportunities.
Yeah, I like it, and I love the one-legged man in the ass kicking contest. This is really what you would expect from him. I guess what people have available now is they have all of the annual Berkshire Hathaway AGM videos that they can watch through either Yahoo Finance or online on YouTube. But there's one resource that I think anyone who, like, it goes over the head of most people that listen to it. I'm going to be frank. In fact, I'm pretty sure it went over the head of me when I first listened to it. But the reason I love this presentation that Charlie did is called The Psychology of Human Misjudgment. It's a thing that you can get on YouTube and you can listen to it. You can't watch it, you can listen to it. You can listen to his speech. and it talks about all of the psychological principles that were covered by Robert Cialdini, Professor Robert Cialdini, in his book Persuasion. But the thing is, he extended that to talk about more principles of human misjudgment and the way our minds misconstrue things. And so it's an absolutely wonderful resource that's freely available on the internet that talks about the way our human mind is frail and makes mistakes all the time. And he just surpassed anything else that you would see in the literature elsewhere. So go and check that out. It's called Psychology of Human Misjudgment speech by Charlie Munger. Anyway, two of my quotes that I always reference from Charlie are, tell me where I'm going to die and I won't go there. It's the power of incentives. And the second one would be, it's easier to avoid stupidity than it is to seek brilliance. And he always talked about this in his Q&A segments with Buffett around, he said the rules for living a good life are quite simple, really. You avoid envy, you live within your means, you invest well for the future, you avoid making massive mistakes. And he would just go on, and there's and he would just be able to rattle these off with a 1 second's notice of how to live, in his opinion, a successful life. And they were just so succinct. He's just a wonderful person. Okay, so do you want to give us the news of the week?
There's quite a bit, to be honest, but happily. We had retail sales come out. There's a couple of companies that had some interesting comments, whether they're about inflation or about cost of doing business increasing. KFC, Collins Food, deliver a massive result as well. Maybe we'll start on there. I found one interesting, which was with what's going on with Origin at the moment. So you've seen Australian Super's got a blocking stake. They don't want the company to be taken private. They own 17% of Origin. There's been a second deal. But AGL came out and said they actually expect electricity demand to double by 2050. And I think we all assume that electricity use is going to reduce. And that's part of the way we meet, targets about net zero. They're expecting it to double by 2050, which means, and that's what's driven their massive investment outside of coal-fired power stations, which they'll end up closing down, I think, within the next 10 or 15 years. So it was interesting to see that. And we always talk about this lack of opportunities to invest in clean energy. I think one of the questions today is related to it, but there's basically no companies that you can invest into renewable energies directly on the ASX at the moment, which is kind of a blight on the blight on the Australian economy. Like the New Zealand has 2 or 3, energy companies. Meridian, I think, is one of them. The US has heaps, but WinLab was one in Australia. They got taken private, but very few options to do that. So that's probably, I found that quite interesting update. And then we had retail sales. I'm not sure how you went on Black Friday. I just had 5 packages turn up on my desk today.
Just had one drop in the door then.
Yeah, a little embarrassing, but retail sales underperformed, or I think below expectations in October.
Which is a shame for all those retailers out there. They love this time of year.
And a lot of, I think, what was it? Clothing was down 1% and restaurants were down 0.4%. So people are slowly eating out less and drinking less. I think I mentioned that about our bars, or the whole city for some reason was off 20 or 30% in September. So whether that's an interest rate hit, maybe something weird happened, the weather was better. I can't remember exactly. And I think we had more inflation data this week too, didn't we?
Drew doesn't remember because he was at the bars making up for it.
Yeah, I think we had inflation data today too, didn't we? Or over, I think it was this morning or yesterday morning. It's been a bit of a blackout with 12 hours in the hospital. So, but inflation's fallen below 5%.
Drew's still under the influence of all the morphine that they gave him.
No, I only got 1 endo and 1 morphine. So,
that's beyond
in that 12-hour period, but nothing like that anymore. No pain-killing prescriptions. But inflation fell below 5%, so that's what buoyed the market this week. So property went up and retailers kind of went up too. Did you look at the Collins Foods report?
I didn't get a chance to get to this.
Yeah.
So fill me in, because I did look at the company about a month ago. I was just doing some research into the business ahead of a session that I had on it. But I'm going to get to it because I'm really interested in this business, because a lot of people don't really know that it doesn't necessarily own the name KFC. It actually licenses it. So
from offshore.
yeah. So Tell us
So
a
they're
bit more
rolling
about it.
out. Is it similar to a Harvey maybe like a Domino's, where they own multiple chains? So KFC and Taco Bell
Yeah.
are
Yep.
the biggest ones, and like all
And
these businesses, the money comes from opening more and more stores until you get to saturation. And if it does, then you start to look overseas, which is what a lot do. Whether that for this could be New Zealand or I don't think Indonesia, but some of those places. But I think everyone was expecting to be worse than it was, but it's probably reflecting what's happening in the economy, and that all the places in the city that are usually full are starting to empty, and then people in the suburbs where you're generally having more mortgage stress might be turning to cheaper fast food again. So sales at KFC were up over 14% at the business, so all their chains were up over 14% in the 6 months, which boosted earnings as well. Same store sales at KFC were up 3%, which, given where they were quite high the year before. And most retailers are showing year-on-year declines. It's actually a bit of an increase and a bit of a surprise in that period.
Well, that's what I expected. When I looked at it a month or so ago, I expected it to slow down. I was just looking at the share price. So the company's up after this week's pop is up 59% year to date. I know Mike Kemp, who I caught up with yesterday. Mike, he's one of the top 20 shareholders of Collins Foods. So no wonder he was so happy yesterday. I didn't realize. That would explain why he had such a big grin on his face. So
Might have had some chicken.
he might have just come from the AGM where he got some original recipe. Go
Definitely. It was a solid result. I mean, we're dwindling off the end of the reporting season too, so just a couple of companies here and there. But people are expecting retail sales to be boosted this month, and it'd be interesting to see whether the pandemic shift has happened, where people were spending significantly more during this period, or if people are bringing forward Christmas spending as well. So that'll be the big result. But we saw, inflation fell. I think it was to like 4.7%. So it feels like rate hikes might be having an impact, at least on parts of the economy. And there's a growing consensus that rates are basically done. Slowly. Doesn't mean they'll be cut. In fact, they can't. I've lost. This is me signing off, and see you in 2024.
So you've got, see you in 2024. I think it was about this time last year you made the call, if I'm not mistaken.
Probably. Yeah, thanks for the reminder.
Okay, so
an interesting one would be ahead of Bill Mitchell coming in, was that the government deficit. So this is the idea that he will explain, is that a government deficit means they're putting more money into the economy, and that is actually a driver of inflation. So we know through infrastructure spending and all these things, it's adding more money to an economy that's already near capacity, or if not beyond it. So the fact that that's slowly shifting to they're expecting it to potentially be a surplus, given higher tax takings, higher all those sort of prices, that might be the first kind of lever in this balancing of inflation. Hopefully.
As in, what do you mean? As in that will be pulled out, or that will be pushed back in?
You're saying if it's a surplus, it means the government is pulling money out of the economy.
Okay.
Whether it's through higher taxes or whatever it happens to be.
It's interesting because in my preparation for the BHP interview yesterday, I was obviously reading the most recent annual reports and tuning into shareholder Q&A and such. And some of the commentary that the BHP team have is that, because they're obviously a gigantic business. I did not know this, but BHP has paid more dividends than any company in the world over the last 3 years. It's the world's number one
how much
dividend
tax they pay across the world. Do
they pay 8% of Australia's corporate tax.
Yeah, it's crazy.
Like, think about how many of us suckers are using Apple. Obviously, they don't pay. Who knows what they pay? But we can just throw some shade on those guys. Pay more tax, Apple. But like, incredible. Anyway.
8% of all corporate tax takings.
8%.
They are the biggest company in Australia.
Biggest mining company in the world. Anyway, when I was thinking, I got perspective not only just when I went into the boardroom and I saw there was like 30 seats in there, but I got perspective in just researching and talking to them that they can't be like one of these mining companies that's just like, oh yeah, there's a great tenement over there, we'll go and develop that. Because it just would never move the needle. So they need to focus on these mega trends. But what they've noticed recently, and this plays into what you were just saying, is a lot of governments around the world are pulling back on things like infrastructure spending, to your point around what are they putting back into the system. And that obviously is having a direct impact on steel prices, on commodity prices, etc. And it's interesting that it seems like Australia's still pretty committed to spending.
Yeah, definitely. I think I think the OECD said we need to push it back. But I mean, if you've been in Melbourne's northeast, the Northeast Link is a
Yeah.
massive project.
Yeah.
I think it's 4 times over budget, and it's just funding. Um,
There's
but
a lot
it's
over budget in
I
Victoria
think
there.
they're spending like 15 billion on that. So it is, and it's the papers makes inflation sound like it's simple, spend less, but not all the levers of spending are in our control, and not all the things we're spending on are inflationary either. So
Mm.
I think that's why we always say that monetary policy is such a blunt tool to deal with these things. It has to be a combination of both.
Yeah, bloody oath. Kate Morris, who we had on the podcast once before, founder of Adore Beauty. What's going on?
The share price popped, didn't it?
Needed
think-
something to happen, to be honest.
It's been tough because I remember there was a lot of talk about how they so Adore Beauty does like that lower
Skincare products.
cost skincare products in not Woolworths
Yeah.
but other similar stores. Yeah, and basically they came out and had said they had rejected a takeover offer. Sent the share price booming, but it's still well below the IPO price. So I think they timed the IPO incredibly well.
Yeah, 2020, their
company's
share price
improving
was nearly $7. To put it in perspective, and the offer was $1.30.
$1.25, $1.30. Yeah, exactly. So this is one of the issues of holding on to, like we talk about. I think there's a question in here about selling the losers as well. That you're waiting for a recovery that may never come, and if you bought it at $7, you may never get. I'll say you never get the $7 back, but the risk is you get a takeover at such a depressed price that gets accepted.
Yeah.
And you never get the upside that you think. So sometimes it is best to cut your losses and move on. Not saying that specifically for Adore Beauty, but in general, as long as you're reinvesting it somewhere that has that long-term compounding opportunity, as Munger would say.
Did you publish an article in the Financial Review this week?
It might have been a week or two ago. It was actually a spread in that. They were looking for quotes or input onto the growth in SMSFs, how SMSFs invest, who uses SMSFs. So, I think Tom Richardson
Oh, yeah,
gave me
Tommy.
a call. Yeah, it was actually over Cup weekend.
Oh.
Just some quotes. I had 6 charts that explain the SMSF sector, which was, so most people with SMSFs are being guided by someone. They generally have higher assets because they want more control and to see what they're investing into. It's also a fixed cost structure. And it's very much about seeing the investments that's driving it.
Cool. I'm surprised Tommy gave you a call over the Cup weekend. I thought he might have been at the races.
I think he's Sydney based.
Yeah, he is, but still, I feel like it. Tom, if you're listening, I feel like let's get you down to the races. My hypothetical question for you this week, Mr. Meredith, is imagine you're 20 years old again, and I give you $200 cash right here, right now, 200 cold ones.
$200 or 200,000?
200,000.
Oh, good.
Yeah. I don't know what you do with $200. But $200,000, $200,000. You could be 20, you could be 22, just early 20s. You got 200 grand. What do you do with the money?
What year is it? Like, where are interest rates set when I get this $200,000?
Right now.
Oh, no, God.
Oh, you're thinking back when you were 20.
Like when I was 20, which...
You'd buy a whole house outright.
10 years ago. You just basically... I mean, the history has shown that in the last 20 years, you should have just put this into property leverage as much as you could and bought more and more property. And I probably have $10 million now. I think it's a very different story today. And what I'd be doing, assuming I probably put completely at 20, put 50 to 100 grand away for deposit flexibility, and I put 100 grand into the markets. Just build a core portfolio as we would for anyone else, but with a growth focus. I think you're going to see more, given what interest rates are doing, more opportunity in companies and themes and sectors over the next 10 years than probably in property.
That's very polarizing. Thank you for that.
Might buy a boat too.
It's also very sensible. You might buy a boat if you're 20.
Maybe a jet ski.
Oh, no. Oh,
That's a joke.
so
No,
Drew's
no, definitely not a jet ski.
cancel culture. If Drew gets a jet ski, he's off the podcast.
I'm kidding. I won't get a jet ski. Don't worry about that.
Anyway, sorry to everyone that has a jet ski out there. Yeah, that's really interesting. I'd probably differ slightly. I'd probably still go with the whole 20. If I could afford it, I'd buy a good quality property. I put 200 grand into it. That's assuming you're probably on the East Coast. If you're on the West Coast, I probably would do.
Buy a jet ski.
Still wouldn't buy a jet ski. It'd take a lot for me to buy a jet ski, if I'm being honest. Like, it would take a lot. But I would say I'd probably, if I wasn't in one of the major eastern cities, which is very expensive, as we know, you'd probably need the 200,000. That's the world that we live in. But if you're able to get away with a deposit of less than that, I would just use that overseas or even more, and then just redraw the equity as a line of credit. Because then you could use that money to go on a holiday, not on a holiday, but you could use that money to go and invest in that core portfolio. So you just get more leverage, is what I'm saying. Like, I think younger people just need to be a bit more financially aware, especially people that invest in stocks in their 20s. That's my biggest regret, is doing it the way I did it. I would have done it very differently if I knew that I could redraw equity and use that equity as a line of credit against income producing assets, which there is a question about. So why don't we transition to questions?
Good segue.
Well, thank you, sir. So the questions that we're answering today were sent in by some wonderful human beings. If you want to be a wonderful human being, all you've got to do is write into us by clicking the Ask a Question link in your podcast player. If you're on Spotify, Apple, wherever you get your sound waves, just click the link there and select the Australian Investors Podcast. Enter your question. If you put in a funny name and your funny name is selected, you get a free pass to the Value Investor Program worth $499. You just write into us if we select your question. Special note, if you want personalized financial advice, you need to go see a financial planner like, say, Drew here, or someone that you can find on Money Smart. We don't know your personal circumstances, needs, goals, or objectives. So when you ask your question, make it generalized, because we can only give generalized financial advice here on a podcast. If we mention ETFs, super funds, insurance, go and read the terms and conditions, the product disclosure statements, and the target market determinations, the TMDs. They're all available on the issuer's website. So if we talk about a Vanguard ETF, there'll be a Vanguard PDS for that ETF. If we talk about insurance or Australian super, there'll be a PDS for that. So go and check those out. It's really important. All right, let's get to the questions. The Chess Master from Bridge Street, good name, creative, a very Australian name there, says, and this one I think is for you, Drew, I have a small portion of my portfolio invested in
I hope it's for me.
invested in a small cap green energy company called Clearview Technologies. Clearview Technologies trades under the ticker symbol, guys, of CPV. It is not at all the Clearview that I thought they were talking about when I started reading about it. My investment was based on a bit of a punt rather than any real analysis, apart from the fact that the company is debt-free. But the share price has been recently showing some significant upward trend, and I'm curious to understand what the trigger is. I understand that these types of companies are probably not something that you guys endorse, but I'm keen to get your thoughts. Are you able to make a brief assessment of the company from your perspective and provide some feedback on the potential benefits and risks? Drew.
No.
Hey.
No, there's some pretty good quotes on there. So basically, it's a company that it's involved in kind of renewable energy, as I was kind of alluding to before. But it seems like they make a technology that can turn windows into like absorbers of energy that they can then use. I like the quote on the front page. Finally, the bean counters and the greenies are on the same recycled page. Financial returns intersect sustainability objectives. I kind of like that, the bit of humor that comes into their mission statement.
Yeah, I like it. Bit of chat GPT on that one.
Yeah, I think the ASX wants to know why the share price is rallying too. So for us to work that out will be quite challenging. But it feels a lot like a small mining company, the way that, and there's a company we probably wouldn't talk about in comparison that did quite well during the pandemic. But what they've done is they've announced a couple of distribution agreements so that their product is getting closer to some level of commercialization. So when that happens, anything can happen with these stock prices. You want to make sure that the distribution agreements convert, they're not conditional and they convert into real income at some point. And I mean, it sounds like the product is commercial, but you've had a close look at the financial statements, I think.
Yeah, most recent quarterly shows grand total of cash receipts of $0. So it's made no cash in the most recent quarter. And that's not terrible. Some companies don't make any money at all. But it basically means that when you approach a company like this, you have to treat it for absolutely what it is. And
That's non-core.
yeah, it is speculative. As they've said, they've taken a punt, which I don't like that phrase, but that's okay. And the thing is that these types of companies they probably deserve more of a place in like a venture capital setting rather than, say, on the ASX. So just treat it accordingly. Drew was referencing when he said the company says they don't know why the share price rallied from 45 to 65 cents because they were pinged. They were issued a speeding ticket by the ASX, and they said they don't know. But just if in case we weren't clear about what the company does, I'm just quoting it directly, an Australian technology company that operates in the building integrated photovoltaic sector that involves the integration of solar technology into building surfaces, specifically glass and building facades, to provide renewable energy. So it sounds like a fantastic thing. And we wish it all the best, obviously. But it is a very small company, and so you've got to treat it accordingly. A lot of the times when these small businesses with 100 mil or sub 100 mil market cap with no revenue on the ASX, basically the only thing that drives it up is sentiment in the short term. So someone said something. As an investor in these types of companies, you just have to be very, very careful that what you're acting on is actual information, because every year there's always one or two companies that come to the market and come to investors. They kind of surface through the 2,500 companies, and they surface to the top based on price momentum and a lot of, like, not going to say pump and dump, but definitely like people on places like Hot Copper, on Twitter, these types of places that talk very positively about a company but have really no substance behind them. So keep that in mind. So Get Rich Slow Club writes in and says, "G'day, Owen and Dr. Andrew." Dr. Andrew? Is that like the vet from the TV? Anyway, "G'day, Owen and
Hopefully.
Dr. Andrew. A couple of episodes ago, I heard you talk about quote unquote real dollar cost averaging. What is the difference between a normal one and the real one?" I don't know. I don't know if this is like tongue in cheek.
This is when we realise that people listen to us a bit too much. I just said good one. Good one for calling out our rubbish. I think it's excellent.
No, but go for it. We're talking inflation adjusted dollar cost averaging. That's what the economists call real dollar cost averaging.
Yeah, of course.
Yeah.
It's just
finance
this. I
jokes.
think we see too many times that when people have a lump sum of capital, they think just splitting it up into two payments is dollar cost averaging. And whilst it might help with the psychological aspect of deploying 500 grand in $250,000 lots, it's not real dollar cost averaging.
Yeah.
So dollar cost averaging is the idea of averaging your input, your entry into the market over an extended period of time, which allows you to benefit from different cycles. So you're buying in bull markets when the market's up, you're buying in bear markets, and your average price will be, consistently lower, or you'll end up with a better compounding outcome than if you were trying to time it based on how you felt. So I compare real dollar cost averaging to something like super guarantee, where you're forced to be investing into markets regularly and you're buying usually the same thing every quarter. And doing it for 25 or 30 years. So it's more that over an extended period of time. The issue with the dollar cost averaging we're talking about is that if the market turns, a lot of people end up just not doing it anymore.
Yeah. It's got to be a
real
habit.
dollar cost averaging is uncomfortable.
Yeah. It's got to be a habit, because you've got to be dollar cost averaging at the worst time, because that's when you get the most benefit. Like right now.
Exactly.
A good example of it is right now, Drew, where 1 or 2 years ago, easy come, easy go with the money flow, you could some people were probably saving, $2,000-$3,000 more than they are today if they've got a mortgage, because the interest rate on their mortgage was bugger all. Like, for example, in my household, we pay $1,500 more or so. I think maybe just under $1,500 more on our mortgage than we did a couple of years ago, right? And so that's $1,500 that's now going to Bank of Melbourne. Thanks for that, Bank of Melbourne. Free plug, no worries. Versus our ETF portfolio. So one of the things that people are struggling with at the moment is like their wallets are getting crimped, like their savings is constrained. So what do? Well, this is the time when real dollar cost averaging kicks in, and you think to yourself, Now, instead of doing $1,500, I'm doing $50. I'm doing $100 because the hardest thing is not putting the money in. The actual hardest thing is maintaining the habit. There was a quote that I had. I'm actually going to bring this up because I thought it was a wonderful quote. This is not me. I did not plan this, but I think I've lost my quote, Drew. I think it might be on my phone because I interviewed. Here we go. Shane Parrish. One of the quotes from his book Clear Thinking was, "Strength of character comes from habits," and it's a really interesting thing. Like, we form these habits, and we form the habits to exemplify who we want to be. And so, if you want to be a long-term compounder, you need to form the habit that would represent you as that person. And so that's what we mean by real, is that type of compounding. Ben writes in and says, Ben, not a very creative name, but I love the question. So credit to you, sir. Ben writes in and says, hi, Owen and team. I like that because you normally get the doctor and I got nothing, and he's just gone team. Maybe he selected the wrong podcast, but that's okay. I'm 37, married with young children. Child care costs are killing me, Ben says. I digress. I'm pretty new to the FIRE concept and interested in managing my portfolio towards the so-called magic 4%. And of course, need that lovely passive income. With all that context, my question is there a point when you should stop reinvesting dividends, this is a good one, Drew, and start actually banking the coin? There are obviously plenty of factors at play. I just want you guys to tell me. So we can't give you personal advice, but you're not asking for it anyway. You have given us a lot of information here, Ben. Childcare costs, Drew will ruminate on that in a second. Just to break down what we're talking about here, FIRE stands for Financial Independence, Retire Early. It's about living within your means and retiring on your terms, sometimes early. And the magic 4% that Ben referenced is actually the 4% rule, where we assume you make a 7% return in retirement. There's 3% inflation, which leaves you with 4% every year to safely withdraw from your retirement balance. Drew, is there a time when you should stop reinvesting dividends and bank the coin?
I mean, it's not really FIRE then, is it? In the content, I mean, there's two questions here. One is reinvesting, and then you drawing income from your portfolio. So it sounds like you're at a point where you do need to start drawing some income to help, have some flexibility. Because the challenge of FIRE, as we saw, I think at the Rask event as well, was that you're delaying gratification, essentially, that you're delaying consumption today for a period in the future, so you can be financially independent. And that's not for everyone. That takes habit and mindset to be able to do that. So I think the question of reinvest will always say that you should put all your money back into cash and rebalance, because the issue with reinvesting is you buy more of the things that have done better, where we'd prefer to be buying low, so buying more of the things that have done worse. So we'll always say invest automatically, but put in a cash account and then reinvest systematically every quarter, separate to that. I mean, I can ruminate on childcare costs, but that's another story for a 2-year-old and a 5-year-old. So
this just kind of blew my mind. I think you should say, how much do you spend on childcare a fortnight?
$1,400 for 2 days for 2 kids,
which is absolutely outrageous.
That's before any rebate or childcare rebate or anything. And
but isn't that
3 or 4-year-old kinder is free?
Yeah. I just think that's completely wild. I've got a book on the shelf behind me here from Anna Cristina, who's appeared on our finance podcast a few times. Kids Ain't Cheap is the book, and it's how to plan financially for parenthood and your family's future. So it's about like long-term investing. It's a good book. It's only just come out, actually. So if you're coming to the Ladies Finance Club in Melbourne event, Ladies Finance Club Melbourne event, that is coming up next week or the week after. There's about 10 tickets left. You can use the coupon code Rask for 10% off. I'll be giving away this book, so as well as 100 other books, literally. So come along and learn about this. But Drew, that sounds like a lot of money for childcare.
Yeah, it definitely is. And I think this is why I think in this context, if you're living a reasonable lifestyle and you can generate and you can draw some of that passive income to help support it and feel a bit more comfortable, then yeah, why not? I think everyone's planning for the future, but you're also incredibly young. So you can either catch up, or you'll probably, if you're this committed to investing, you'll probably be fine in terms of your strategy if you happen to draw a bit more income from it for a few years.
It's one of those things, isn't it, where a lot of people that worry about the thing actually don't have to worry about it. It's the people that aren't worrying about it, they're the ones that should. I think Nick Majuli talked about this in his book. He's quoted the savings, a study into savings and budgeting in the United States, where he talked about people, the stress of budgeting for an outcome is actually more stressful than not achieving the outcome. There's a study that shows that. So people are more fearful of the thing, and that causes more problems than actually the thing itself. In this instance, if someone's young and they get the super guarantee, as you said, I think that's a wonderful backstop for people. It's if someone's like on a single income, they work on an ABN, they don't pay themselves super, they're not following all the savings habits. And that's where it becomes a really big problem, in my opinion, that savings hygiene. And I would just say when people are young, I prefer to just reinvest, just keep reinvesting, don't sweat it, just focus on earning more, spending less, and compounding.
Exactly.
Yeah. Second income in the case of a family can do wonders, assuming that you're mindful of anything to do with childcare subsidies. Okay, we've got time for a couple more here, Drew. Stock Stumbler says, this is an interesting one. Hi, guys. I have been investing around 20% of my income over the past 18 months with some basic ETFs like IOZ, IVV, along with some high-quality businesses like CSL and Washington H. Soul Pattinson, along with some others that make up around 50% of my portfolio with ETFs and the other 50%. My question is, how long do I give myself to see if I can beat the market before I make a decision to continue picking some stocks or direct all of my investments towards core ETFs? Drew,
Forever.
you reckon forever?
Like there's no reason you have to beat the market in any given year. The market could fall 20%, and you do positive, or you do negative 18%. Like the market, I don't think your focus should only be on the market. It should be on compounding and growing the value of your wealth over time. So I think you can always balance both, and the important thing is making sure you're engaged in investing, which it sounds like you are. You're buying quality businesses there, and maybe like someone else speculating a little bit in small areas, but the fact that you're exposed to market, I think, is the most important thing. And worrying about short-term returns when you're probably investing for 20 or 30 years, whether you're beating the market with 5 stock picks, I think is less relevant as long as you've got the core of your portfolio right.
Yeah. Like it. I would probably just take a slightly different approach, and I would say it's great to continue to invest in companies for forever, as Drew would say, but a lot of people don't have the ongoing curiosity and the passion for it. A way you can determine if you're any good at it is to download or use an app like Navexa, Navexa, or ShareSite, and they can integrate directly with your investing brokerage account or your app. And it will track your portfolio against benchmarks, like a 60-40 portfolio, or track it against an ASX 200 index, or track it against another ETF. And you can actually see after 2 or 3 years, is what I would say, how you're doing and how you're faring. And that type of reflection is actually a really good activity for everyone to do. Rosie writes in and says, I would like to add an ASX 200 ETF to my portfolio. I noticed that the BetaShares A200 ETF is currently about $177 per unit, while the iShares IOZ ETF is currently listed at about $28 per unit. Why the massive price difference for what is essentially the same ETF, and why would someone pick one over the other? The answer to that question, Rosie, is you can cut a pizza into 10 slices or you can cut it into 5. It doesn't really matter how many ways you cut it. It's still the same thing underneath. So that's what I would say. It doesn't make a difference. It's just that you're not betting on the total value of the share price. What you're betting on is how many units you can get. Drew?
Yeah, see, I think it's a common question that comes up all the time. So, but exactly right. You're still getting the same exposure to the market, and it only really matters when it comes to reinvestment. That if you're automatically reinvesting on very small amounts, then it takes longer to buy a new unit, $177. So we usually run on cost and liquidity. Both are very similar. We naturally prefer iShares. No offense to BetaShares, but the BlackRock name is the biggest asset manager in the world, and I think the cost is pretty much the same. Maybe BetaShares has just undercut BlackRock slightly, but you're basically buying the same thing. It just has a slightly different unit price because they started at different times or started at a different unit price at the beginning.
Yeah. So, for example, Rosie, when the ETFs may have started, one may have started at, and said, day one, we're
Dollars.
going to price this at 100. The other one says, we're going to price it at 20. And over time, those fluctuate. And eventually, what they can do is they can actually they can divide it up again. So, again, if one of the ETFs gets to $200 and more people like yourself write in and say, hey, this is too high, I can't reinvest my $5 dividend anymore. Then what they might do is they might break it up again. They might do what's called a stock split. And in that case, they'd go from $200 and they might say, we're going to do a 1 for 10. So meaning that you'll get 10 new ones for the one that you had previously. So then it drops back down to 20. And it really doesn't matter. It's kind of like, I had Domino's pizza the other night. It was absolutely horrible. I feel like I had hallucinations the next day because I ate this pizza. Shout out to shout out to Domino's.
We'll take a discount code.
The last time I had Domino's, I absolutely loved it, but this time around, it was just a shocking experience. Anyway, which is not great.
Probably shouldn't tell the audience that you're having Domino's twice.
Yeah,
Was it last week too?
No, just once. Anyway, my point is, like, it matters what you're getting inside the box, not like how much, what kind of cost it is or how many ways it's cut. Basically, it matters what you're getting, and in this case, you're getting exactly the same thing, just cut in a different way. So you can just choose the one, as Drew said, which most suits your goals. Dunning-Kruger. Final question. Dunning's wrote it in a few times. My first investment was an ETF that was ethically minded, IMPQ, which is the perennial better future one. We've had co-portfolio manager or lead analyst on the show before. I didn't know anything about investing, but I dove in and invested and was buying more and more. And it went further down. Because I was awfully bad at investing, I'm now building a core portfolio after listening to your podcast for the last couple of years, and a previous episode told me that there's sometimes huge fees in green ETFs. And sure enough, this one's huge. So my question is, the ETF I own is now way down. So do I keep buying in even though the fees are so high, or do I sell out, cut my losses, and invest in my core portfolio?
I think the important one here is knowing what you're paying for. So that's part of the golden rules is we use passive and active management in different cases, and green or ethical or ESG investing requires a lot more work than someone who's basically trying to track the index. So that's why the fee on this is about, I think, 1% plus performance fee. And that's, you have to do a lot more work to find out how bad or good a company is and put that portfolio together. So I'd always there's two questions here. One would be cutting losses, and two be the question of fees. So on the fee question, it's very much, are they doing something significantly different that you could buy elsewhere? And you have to answer that question yourself. I think that would be too much personal advice. And the second one would be about cutting losses. And it probably relates to that like Adore Beauty discussion we had at the beginning, which is, do you still align with the investments in this? Do you think the opportunity with this portfolio is still there? And the last one is, are you still comfortable holding it, or is there better growth potential and recovery potential somewhere else? We're very big on, when something bad happens, cut your losses as emotionally difficult as it can be, but make sure you're applying it to something where you have the potential to recoup that and hopefully compound over a longer period of time.
So don't make a mistake in rushing to the exits.
Sometimes there's things like ARC where it's significantly changed, and maybe some, like a lot of those Adore, all these things that are down 80 or 90%, they may never recover enough to get you back to break even. But this is I think the better future product. So it's smaller companies with a green tilt, both of which have done incredibly badly for economic reasons or just preference for large companies. And I don't think this fund or ETF is alone within that sector as performing that way. So it's whether that's still an opportunity, whether you still align with it. I don't see there's like a venture capital investment that's fallen 90% and will never recover. Yeah. In terms of comparison to green investing.
Yeah, fair enough. While I formulate a response to Dunning-Kruger here, maybe you should get your joke of the week, your dad joke.
Oh, it's ready. Don't worry. I just Googled dad joke involving fennel, but there weren't any that came up. The fennel frontier was one.
Oh, gosh.
The fennel countdown.
Oh, my gosh. Okay, hold on a second. I would just say with this one is
salad related, though.
Sunk cost fallacy is a really big thing you invest in, or price anchoring in this case. And trying to make a decision under those situations is difficult. If I relate this back to Shane's book that I've been reading recently, positioning is the thing that improves outcomes, not necessarily decision making by itself, as Drew just loses control of his
Stuck in my
headphones.
chair. So it's been a
Um,
rough week.
So if you think about positioning your portfolio for the future, that's basically what we're talking about. And so try not to look at the past as a gauge to the future. I think it was Maynard Keynes that said, I don't think the remedy for a falling stock price is to sell at the bottom. And sometimes it is, sometimes it isn't. Another quote that I'll bring in was from Joe Mager, a friend of mine, really good investor, who said, like, you should treat your portfolio every day as if you are buying that portfolio because you have the option to sell at any moment. And I think in this instance, obviously I can't tell them what to do, but it's just weighing it up against your long-term goals and if it still fits within that framework. I think one of the mistakes that people make is recency bias, where they look at a company or a fund's performance over 1 or 2 years and they don't consider the environment that they're in. So green or ethical style companies and strategies tend to just invest in high quality industrial businesses. And if it's a small cap strategy, as Drew was saying, you tend to end up with small cap industrial companies. And those types of companies tend to do well in an environment where interest rates are flat or lower, because they're the types of businesses that tend to benefit from an expanding economy and from monetary policy easing. And this is something that many people don't understand who are not in investment research, is there are different strategies for different market environments. And you need to understand that in order to make an informed decision. In this case, you're going to get volatility, you're going to get a lot of uncertainty on the way down, but there will come a time when strategies like this, I'm not saying this one in particular, but like this, do pay off. So it's about knowing where that sits. And finally, if your fee budget, if you've realized an investment is a lot higher fee than you thought it was, you should have a fee budget of how much are you going to spend as fees for my portfolio. And if this is not where you want to allocate more of the fee budget, don't do it. Like you always say this all the time, Drew, that Australian Super's balance strategy has a blended fee of around about 0.75%. So if most of the portfolio is in super low cost in ETFs and it's only this one thing that's a bit more expensive, well, maybe that's okay. But if they're all like this, then maybe there's another constraint there that people need to put in place. Hopefully that waffling does something. But if you want to get in contact with Wattle Partners and Drew Meredith, you can go online. There's a link in your podcast player that says that says financial planning. Click on that and you get matched with a financial planner. You can book a call with Fatuma or Renato or someone in the team at Wattle Partners. If you're in retirement, get in contact with them. And if you want to stick around and hear what we've got to say next week, be sure to subscribe to the Australian Investors Podcast. Or if you're on YouTube, hit subscribe and you'll get notified whenever we go live. Drew, we've got to see out the rest of today's show with one very important ingredient. Actually, we've got two. One is the best name, and I'll go for the first one, which is the Chess Master from Bridge Street. I thought that was a wonderful name. If that's you, write into us. You won the award. Congratulations. But Drew, the thing that I really want to hear is this week's dad joke.
Yeah, I lost concentration last time. Something happened off air. So I'm all on top this time. And I think I have to stick with the salad puns in this case.
Mm-hmm. It's fitting.
Just to like we did with the fish bank or the riverbank.
Mm-hmm.
So this week we've got, what do you call a chicken with salad in his eyes?
Don't know.
Chicken sees a salad.
Not bad.
It's a good one.
Not bad, mate. Not bad. I think that's pretty good. I'll give you a 7 out of 10.
I'll
Really good
take
dad
that.
joke.
I'll
That's a
definitely
good
take
dad
that.
joke. Assuming your kids know what a Caesar salad is, I think that's a pretty good joke. Well, mate, this has been heaps of fun as always. So thanks for joining me.
Awesome. Good to see you.